The average American with student loans is carrying roughly $39,000 in education debt. That number alone does not stop you from buying a house. What stops you is the quiet arithmetic that happens inside a lender's software long before anyone hands you keys. You can walk into a bank with $80,000 in student loans and still get approved for a mortgage. You can also walk in with half that amount and get declined. The difference is not the total balance. It is the monthly payment the system decides to count against you. And that decision is neither consistent nor especially transparent. This is the part almost no one explains until it is too late. For years, the official story has been straightforward. Get the degree, borrow what you need, land the job, then buy the house. The sequence was sold as the modern American path. What the sequence never fully accounted for was the moment those two debts collide on the same credit report. Student loan payments resumed in force after the long pandemic pause. Enforcement tools are back. Delinquency rates have climbed, and in 2026 the share of student loan borrowers who also hold a mortgage and are behind on that mortgage has risen sharply. One recent analysis found those borrowers are nearly 4 times more likely to fall behind on their home loan than borrowers without education debt. The system that was supposed to create mobility is now generating a second, quieter form of precarity. Here is how the machine actually works. When a lender underwrites a mortgage, the single most important number is your debt-to-income ratio. Take every monthly debt obligation you already carry, add the new mortgage payment, and divide by your gross monthly income. Most conventional programs prefer that total under 43%. Some stretch to 50%. FHA can go higher with compensating factors. VA loans care more about residual income than a hard ceiling. The exact limit varies, but the principle does not. Every dollar of monthly debt already on the books shrinks the room left for a house payment. Student loans enter that equation in ways that feel almost arbitrary. If your credit report shows a regular monthly payment, the lender usually takes that number. If the report shows 0 because you are on an income-driven plan, in deferment, or still in forbearance, the system inserts a placeholder. And the placeholder changes depending on which government-backed program you choose. Fannie Mae will often accept a documented 0 payment on an income-driven plan. Freddie Mac tends to use 0.5% of the outstanding balance. FHA also defaults to 0.5% when the reported payment is 0. Conventional lenders without special documentation sometimes still reach for the old 1% rule. On a $60,000 balance, the difference between a 0 and a $600 placeholder is the difference between qualifying for the house you want and watching it disappear from the approval letter. This is not a small technicality. Every $100 of extra monthly debt counted against you can reduce the purchase price you qualify for by $15,000 to $20,000 at current rates. A borrower on a genuine low-income-driven payment can clear a far higher price point than an identical borrower whose loans are treated under the stricter placeholder. The same person, same income, same credit score, different outcome depending on which form of debt calculation the underwriter applies. The absurdity is hard to miss. The federal government designed income-driven repayment to keep monthly payments manageable so borrowers would not default. Then the same government-backed mortgage system sometimes pretends those manageable payments do not exist and invents a larger number instead. The result is a quiet tax on people who follow the repayment rules exactly as written. There is a second, less discussed cost. Even when the monthly payment clears the DTI test, the existence of the debt slows the accumulation of a down payment. An average federal student loan payment sits near $400 a month. Over 5 years, that is $24,000 that never reaches a savings account. In high-cost markets, that delay can stretch into the better part of a decade. The median age of a first-time homebuyer has already climbed toward 40. Student debt is one of the quieter reasons. Popular advice often splits into two camps. One side says pay the student loans down aggressively before even thinking about a house. The other side says buy as soon as the DTI works because home prices and rates will not wait. Both contain partial truths, and both understate the risk. Carrying both forms of debt at once is common. Roughly 37% of first-time buyers already do it. Yet the data on dual delinquency is uncomfortable. When student loan payments become hard, the mortgage is often the next payment that slips. The household that looked fine on paper at closing can become fragile the moment income dips or rates reset. The deeper tension sits at the level of policy design. Higher education was expanded with the promise that the degree would more than pay for itself through higher lifetime earnings. Housing policy still treats home ownership as the primary vehicle for middle-class wealth building. Those two systems now pull against each other. The debt required to access the first asset makes the second asset harder to reach, later, and smaller. Borrowers with student debt spend, on average, nearly 40% less on their homes than buyers without it. They buy later. They build equity more slowly. The wealth gap compounds. None of this means the door is closed. People with six-figure student balances close on houses every month. The right loan program, clean documentation of an income-driven payment, strong residual income and cash reserves can still make the numbers work. VA borrowers in particular often find more flexibility. Some conventional files will accept a true zero payment when the paperwork is airtight. The path exists. It is simply narrower and more technical than the promotional materials suggest. What remains unresolved is whether the current arrangement is sustainable. A generation was told that borrowing for education was an investment. That same generation now discovers the investment functions in practice as a long-term claim on future cash flow that competes directly with the other long-term claim required for middle-class stability. The percentages still look manageable on a lender's screen. The lived arithmetic often does not. The question that lingers is simpler and harder than any underwriting guideline. If the price of the credential that is supposed to unlock economic mobility is a permanent reduction in the ability to own shelter, what exactly is the mobility for? The numbers keep arriving. Home prices remain elevated relative to wages. Student loan delinquency continues to track higher mortgage stress. Policy changes in repayment plans shift monthly obligations without changing the underlying collision between the two debts. Each year, the median first-time buyer grows older. Each year, the equity gap between those who entered the housing market early and those still waiting widens a little further. The system still produces approvals. It also produces a quieter form of exclusion that compounds over decades. The question is no longer whether a borrower with student loans can buy a house. It is whether enough of them will in time for the old promise of middle-class ownership to remain intact.